Hey everyone, you're listening to the Active Turnkey podcast, a podcast designed for hands-off, passive real estate rental investors. In the Active Turnkey podcast, you'll hear Tom Olson and Jarod Stotmeister discuss all things turnkey rentals with other turnkey providers, service providers, and rental investors. Our goal is to help you reach your financial freedom and whatever comes after that. Let's go. Welcome back to the Active Turnkey podcast. I'm your host, Jarod Stotmeister, with the Tom Olson, the Tom Olson, the owner of Good Success and Olson Group. And we have another exciting podcast for you. This one will be interesting. This is definitely something to get you thinking. And everybody has an opinion on this for sure. And some of us may not be as staunch in our opinions on this. But today's podcast is about diversification versus diversification. Or diversification.
Jarod, you use the word staunch. What does that mean?
As in, like, I plant my flag here.
Okay.
I'm planting my flag.
Just want to make sure the audience knew, because if I didn't know what you were trying to mean there, I thought
that is my interpretation of the word staunch.
The word staunch.
Yes.
At least it wasn't stench.
No. I mean, hey, maybe that's something you're worried about. Maybe,
I don't know.
Maybe you're not confident. Yeah. No, we're good here. I am in a room with Tom.
No stench here in this room.
We're good. Right. So
you can smell through the broadcast right now.
Sure.
Yes.
I promise you, we're good here.
Okay.
So diversification. We're focusing on the diversification, but it's kind of with a lens of comparing it with diversification. So if you haven't heard what diversification is, which I actually hadn't heard it till Tom mentioned it to me just a few weeks ago, but I don't really do a stock market. I'm more in real estate myself. So Tom, what is diversification?
Oh my word. Well, you're going to put me on the spot here, Jarod. So I don't really know what the definition of it is, but it's a term I heard in a mastermind group about 8 or 9 months ago, and I really grabbed a hold of it. And I think when you follow the stock market, or you follow those types of groups, or read different magazines that are focused and geared toward getting you to invest in the stock market, there's so many people out there that talk about diversification as if it's an absolute necessity in order to be successful in investing. And from what I heard of it, it was kind of like the opposite of that. It was almost as if you don't necessarily have to be diversified in order to be in a good position. And I think I really do believe that most stockbrokers have it all wrong. They think that you just have to throw a bunch of crap against a wall and hopefully something sticks, and the stuff that sticks and the stuff that falls down will balance itself out, and that's the reason why you want to diversify. And when I saw this presentation, the gentleman that was presenting, his name is Richard Wilson, who runs the Single Family Office Club and has an amazing group there, and I would recommend it to anybody. Billionaires in that room, and it's amazing to be able to be in an awesome environment like that. But he kind of coupled that, this term diversification with kind of Warren Buffett's statement. You hear all the time, don't put all your eggs in one basket, right? So I think that people think that's really a good thing because people say it. A lot of people say it, so it must be a good thing. So if you were going to diversify, Jarod, in real estate, for instance, what would that mean to you? Would that mean I should just buy a house in Indiana, and then buy a house in Pennsylvania, and then maybe buy a house in California, and then buy a house in New York, and then buy a house in Florida, and then maybe one in Alabama? I mean, really, if you were to do that, you're going to find out in a real quick period of time that is diversification. It doesn't help. It's not helpful. It's actually harmful, I think, in the long run. And really, so Warren Buffett's quote on this, and for some reason he's also quoted to say don't put all your eggs in one basket, which I don't really believe he actually ever said that, but he's quoted as saying that over and over again. But his actual quote about the eggs in baskets, he actually says, put all your eggs in one basket, but watch that basket very closely. So basically, this whole thought process of putting all your eggs in one basket, why would you want to do that? Well, it's so you can keep an eye on them. And, so you want to have more eggs than one. I mean, I don't think that's, we're not, negating that or saying that you shouldn't have more eggs. You ought to have more eggs. But if you have a lot of eggs, you might want to put a lot of them in one basket before you get another basket.
Sure. Yep.
And if you look at Warren Buffett, he has not made money by being what the stock market gurus would tell you to be diversified. He hasn't. No, he's made all of his money by being very successful in one business and then taking the profits from that one business and then knowing a lot about another business and then investing in that business and then making that business very profitable and then taking the profits from both of those at the same time and investing them into another business. So it's kind of like the same thing that we teach about even in Good Success. We talk about this where I think a lot of kids nowadays think they should own their own business when they're 18, 19, 20 years old. And I honestly just don't believe it's a very wise decision for most people. They might have a side business, but they should learn how to work and how to run and how to from somebody else. You don't go and be a 4-star general when you go in the military, right? No. Where do you start? On the ground. So there's a process to this, and people get the process way out of whack. So diversification is when you get the process out of whack. Diversification, in my opinion, would be like an 18-year-old starting their own business when they probably should have figured out the process with somebody else, working for somebody else, being more, the Bible actually says, why should you be given anything unless you've been a good steward of somebody else's first? Sure. So to investing, I think you ought to make money in your own income, whatever it is that you're doing, and then he even says in another quote, he says, "Don't rely on one stream of income." Okay, so you might think, well, those two statements are contradictory, but they're not. He says, Warren Buffett says, "Don't rely on one stream of income. Make investments to create a second stream of income." So to me, what that's saying is you want to get that basket so full of eggs and make sure that thing's humming and it can sustain itself before you go then and invest in another basket. So, I know we kind of coupled a couple different things here. Sure. We kind of got off a little bit diversification, but it really is. It's a funny word. Diversification basically means that you're worse off by making investments than you would have been if you would have just maybe invested in one single thing over and over and over again. So I think a lot of it goes back to the knowledge base and what you can bring to the table. The more you know about a particular subject, or if it's in real estate, maybe an asset class, or even a developer, the better relationship you have with that one developer. I'm not saying you should never diversify across the country and have properties in different parts of the country. I don't agree with that. I mean, I think you probably should, but I believe that you ought to go really deep in those markets. It's much better to go deep in 2 or 3 markets than it is to go really wide and just keep buying properties all over the country. And I'm going to tell you, in the end, it's going to hurt you because of how much time it's going to take you to manage all those people. You go back to Warren Buffett's statement and he says, watch that basket really closely. Well, you can't watch 20 baskets really closely. Right. We're Christians and we know that Jesus only had 12 disciples. He probably could have handled more, but he still said, I only have so much time on this earth, in my earthly body, to invest into so many people. So, you can really only handle and manage so much with the time that we have. You manage quite a few employees, Jarod. I mean, on a daily basis, you're probably managing 7 or 8. Imagine if you had to manage 15 or 20 doing the same things that you're doing right now. It doesn't mean you couldn't have 15 people working for you, but they'd have to be managed by the people that you manage. So I think there's a cap on how much we can manage.
Totally.
And I think that also goes into this whole, thought process of diversification, which I think is actually worse off than just investing into one product and one person and one developer.
So now with that in mind, which sounds like you've spent some time thinking about this whole thing. It sounds.
I mean, a little bit. It's gone through my head, and I connected so well with Richard when he said that, because I was like, "You're so true," and I've seen it with my own. I've seen it with my own investors.
Well, that's what my next question was. So now with that whole mindset in mind, how does that relate with real estate turnkey investors. So now taking all that,
Yep.
how would we
So
look
I
at
have
that
had
perspective?
so many people in the last year, and this kind of didn't really start happening to us until about the last year, but I've had 4 or 5 people tell me, I wish I would have just invested all of my money and all of my products in you. And I'm not saying that like because I think I'm all that or I'm all great. I'm telling you what my investors have told me. My investors have said I would have been so much better off if I would have just went with one person. And the whole time that I was dealing with them, I was even pushing them to other people, saying not because I didn't want their money or not because I didn't want them to invest in us, but just because I don't want to be self-serving. I really do want to. And some of these guys that they invested with are my friends, so I would push them to other markets and to other people and saying, hey, you want to have some kind of diversification. But at the end of the day, if it's not good for you, maybe you would have been better off putting all your money in their basket or we're working with them. That's totally fine. All I'm trying to say is when you're investing and you find out what works, I would recommend going back to the well. If you are a lender and you're loaning money to somebody and they pay you back, well, I would go back to that well. I do it with my own personal money. If somebody pays me back, I'm wanting to go back to that same person and give him my money again. If I'm going to buy a turnkey rental property and I'm going to buy a property and it's performing and I'm seeing it work, like I want to go back to that person and I want to see, how we can continue to expand that. So we might start with 4 or 5 or 6 houses at a time, to start with, and maybe then get that up to 20. And then, when I'm getting a nice, decent sized portfolio in a market of 10 or 20 properties, I think that's at least a large enough statistical snapshot to kind of know like if it's going to work or not. Then I might consider like, okay, my basket has, 10 or 12 or 20 properties in it. Maybe then I still might want to keep going back to that well or back to that market, but I might say, okay, what happens if a market turns or you have a shift at some point in the history, in the future? Like right now in our market, I think we are still sitting at this amazing opportunity stage, and it's almost like it's just been building for the last 2 years, and now I feel like it's about ready to explode. And we've positioned ourselves so well for ourselves and for our investors, I believe, to be able to take advantage of expansion and for people moving and to people staying, in our area, that I feel like we've put ourselves in a really good position. But there's other markets around the country that are the same way. But the difference is the other markets have already had some price increase, but there are good markets. The problem is if you have a great market and if you don't have a great person on the ground, that could also be diversification. So like you might have great areas, you might have studied and all the best areas in the country, but if you don't work with the best people, and they don't have the best processes and they don't get the best tenants, like then it doesn't matter either. So at the end of the day, I'd rather be in a subpar or a lesser market with an amazing provider than be in an amazing market with a horrible provider. Because at the end of the day, like I'm more about the trust factor, and I'm wanting to make sure that I can have a part of that as well. So I think all those goes into your question, but really like I love the word. It's kind of a funny word, diversification. Like everybody's kind of makes fun of the word diversification to a certain degree, but I'm glad you brought it up. It's a really interesting topic.
So let's look into that. Let's think about the mindset of the turnkey rental investor, and you hear that don't put all your eggs in one basket, and you hear that you need to diversify, and so you're happy with your results. We've had many investors who come back and say, I'm really happy. We had one just recently, a friend of ours who's locally, he lives in Chicago, selling what he has in Chicago to invest here, and he has feeling the pull to diversify because you're supposed to. And yet he has said that he doesn't really, he likes working with us and he likes buying with us. So that's his struggle is, do I continue going with the people I like to work with, or do I diversify like I'm being told? So along that line, let's talk about that mindset. So first of all, if we were on the phone with an investor who's dealing with that kind of an issue, I think the first thing we would say is, why are you diversifying? Like deep down, not just because you're told to, but literally if you could answer that question and you explain it to me, why are you diversifying? How would you work with a person like that, or how would you even answer that question?
If I was the person asking the why, or if both. I was the person. So if I'm the person, I know why. There are reasons why you'd want to diversify, and and I've already mentioned a couple already on this podcast. I believe that real estate in general has become I say real estate in general, but it's become more specific. It's become more, real estate is very regionalized, so much more than it's ever been. There is really no national market anymore.
Sure.
And you can go back 20, 30 years and see how it's gotten worse and worse and worse. In 2008, areas like Boston got decimated. I mean, their price points like dropped 50%. But then in the same exact time frame, in the same type of populated area like Dallas, Texas, property values barely even dipped. I mean, maybe 10%, maybe 20% in some areas. But you have those two completely different markets that like did almost the exact opposite thing at the exact same time. And you would think that there's some similarities to those markets, but they didn't do the same thing. So I think a lot of that, I think we have to determine that. We have to think about that. We have to think about, what markets have already had major shifts. If you are investing in a market that's already had like 100% increase over the last 10 years, well, maybe it's a time to be looking at areas that haven't had that type of an increase. I also think you have to know what you want. Do you want cash flow, or are you really focused on appreciation? And I think it's funny too, because everybody looks at appreciation and says, I want to buy in areas that have appreciated over the last 10 years because those are appreciation market, right? That doesn't make any sense to me. Like, if you're blowing up a balloon and a balloon's already full, like, what makes you think that there's more air that can go in that balloon? Eventually that balloon's going to pop, and when that balloon pops, like, that's not the area I want to be. I want to be investing in those areas that haven't done so, but have a chance to have positioned themselves to be able to even for appreciation's sake. And then the other reason to invest is for to be able to leave a legacy or to be able to pass these things on. There's many different reasons. So I think you have to know why. You have to go back to the whole why. Why are you doing investing in the first place?
Right.
And then second of all, you really want to make sure that the market, but also know the person. Those are the two. I think those are the two most important things. But also, I think the third most important thing is the market, the actual market itself of renters. Like, how are the renters in that market? The actual quality of your customer, because that's who your customer really is the tenant at the end of the day. So knowing, how well those are going to perform. And honestly, I think there's a fourth thing, and that's the government. We've even seen, we've seen through this coronavirus thing, I think there's going to be states that are going to be judged very harshly on how they reacted, how much liberties they took away from people for how long. And I honestly believe that those states that took way longer to open up are going to be judged much more harshly in the investment realm, because people are going to know, hey, if I want to invest my money, I'm thinking about, there's 4 or 5 states that I can tell you that opened up really early, and honestly, there's states that never shut down. And those are states that we don't really talk about a lot. But there's some states out there that I think people are going to be considering now, because, that's a big risk at some point if people can't work.
Sure.
So, that could be diversification to a certain degree. You think you want to go all around the country? Well, why don't you look at diversifying only in those states that like were reasonable about staying shut, opening, and honestly, also think about the difference right now in unemployment. So the unemployment is, everybody's talking about it.
Sure.
Unemployment's 25 million, and it sounds horrible. We have no idea what this is going to look like in a couple months. It's possible that it could just drop really quickly, and a lot of people are going to go back to work. I think that's really the key factor that's going to happen the next 6 to 9 months here, is seeing how many of these people actually go back to work and how many of these businesses just never open back up again. But really, the governments are the ones that are going to be judged for that. And I think that could be there are areas that didn't get hit as hard with that. The areas of the country that have more factory workers that stayed working, or had more essential workers that stayed working, aren't going to see as much of a change, as some of the other areas. I think right now, like New York is going to get decimated. There's already reports of the people that have the means moving away from Boston and moving away from those areas. So supply and demand's a big deal. So I think that we have to look at that as well. I mean, the other thing you could think about is, a lot of people that own multifamily, units right now are saying, well, I'm diversified because I have 600 units in one. And I think for the most part, that's been a good stance. I think today, though, I actually think you might be better off owning 600 single family residences because people are moving. The renter pool is moving as fast as they possibly can to the single family asset class. So again, you got to make the decision for yourself.
Absolutely.
You've got to figure that out. What's really good for you. I mean, I invest in my things that I understand, and like for me and my wife also own 14 vacation rentals, and we manage to for some other people. But that's something that we know, and that's something that we are figuring out ourselves, and we're adding to that. We're not just investing in it. So I think diversification becomes even worse if you don't know about it. So the more you can know about a subject, and the more you can invest yourself in knowledge and in value. If you can add a value piece to your investment, to your money. I think it's so much more smart. It's and if you follow Warren Buffett, that's what he's always done. Sure. Warren Buffett has never ever invested in something he knew nothing about. And I think that's really what the difference between diversification and diversification is the more if you're investing in a mutual fund, you know nothing about most of those. Sure. Those things. And I mean, don't even get me started on where the money's all made, but the money's all made in the IPO and the multiple on what you're paying on potential earnings. And it's at this point, it's literally turned into going to the casino and gambling because you're just hoping on a prayer. You have no real, asset there. And I really believe with, in the long term right now, we should be looking at hard assets that do appreciate in value. But also, I think the hard thing right now is people think about hard assets and they think about silver and gold. And I'm not really against silver or gold. It's more of a hedge more than anything else. But silver or gold does not give you a monthly benefit. It does not give you any kind of, in the stock market, you would say a dividend. Real estate is a high dividend investment. Sure. And so I think that cash flow is what really helps hold things together in good times and bad. So at the end of the day, you want diversification so you don't lose it all. It's more about preservation of capital than it is anything else. But I think it can turn into diversification, or it can turn worse off for you if you're too heavily invested in something that's not really you don't understand and you don't know when to pull out. Or it can be worse if you're just throwing, dirt or mud up against a wall and hoping something sticks because you're putting all of your eggs in somebody else's basket. It's not even your own basket.
That's really good. So a lot of that is mindset. So it's finding out what you know about what you're investing in, who you're working with. Those are all different things. And so that kind of does transition into the next one is, so again, we're talking mindset, and the point of why we're asking why you're diversifying is not that you understand the concept of diversification. It's why are you actually trying to do it? Do you know why you're doing this presently? And in that case, the next question we would ask is how good are you at managing what you have now? And so I don't know if you want to
absolutely. So that goes right back into my Warren Buffett stories. You cannot expect to just go from 0 to 12 different investment vehicles and think that you're going to be able to manage them all. It takes time to learn it. Now, don't get me wrong. You can manage investments on a very small period of time, but you need to learn those. So those take time. I mean, honestly, it's like starting 12 businesses. You can't start 12 businesses at one time and expect any of them to really succeed. They might all fail because of that. Sure. And it'd be better if you started one, made that one succeed, and then start another one, make that one succeed, and start another one, and make that other one succeed. So really, if you're gonna diversify, I'm not trying to say I'm against diversification at all. Trust me, I diversify in different things that I do. I only have 4 or 5 things that I'm doing. I don't believe in this I should have investments in 100 different places. I really want key 3 or 4 things that I know that I know how to vet, I know how to approve, I know how to, I know enough about it to pull it back if I need to. and I know when to pull back if I need to, or I know when to cash out or go to cash if so to speak, if I need to. So I think I think that's a great question. Are you good at managing multiple things? And maybe you are, and that's fine. But most of us aren't.
Sure.
Most of us can really only focus on about 5 things at a time. And then once you get past 5 things, it can be really, there's books out there that say you can't do more than one thing at a time. You think you can, but you really can't. You can really only do one thing at a time. So with the time that we have, I actually honestly believe most people ought to have most of their portfolio in only 4 or 5 buckets. And now they may have lots of eggs or lots of investments in those buckets, but they ought to be really kind of dialed in to what they know. And I think that a lot of that does go into you. Like, how much can you manage? Do you really want to manage 20 managers? I know I don't.
Well, it's definitely, a lot of people know that the effort that goes into managing one. And so now you compound that with up to 20. I mean, I had an investor I spoke to. I mentioned this before in the podcast. He was in 8 different markets, and 3 of them were doing well. The other ones were awful. I mean, it's a great example. And
that's what I've seen.
8,
from my investors. That's exactly what I've seen. Like, you're going to invest into 4 or 5 markets, and you're going to find 1 or 2 that you really end up saying. So if it was me and I was in that situation, I would be divesting myself of those other investments. I would not just kind of try to continue those on. I would get out of those other places. I'd sell the properties, even if you break even, or even if you have to lose a little bit of money, because like you want to get into those other areas in which, or in those other relationships that you've already developed, that you already have a good trust for. I love the book Speed of Trust, and that's really like business works at the speed of trust. And the more you trust somebody, and the more you trust somebody's system, like as that grows, like that's what you really want in the end. In the end of the day, that's what you really want.
And actually, by staying in that situation, staying in the 8 markets, you're actually going against the whole point of diversification.
Exactly.
The whole concept.
Which turns into diversification.
Exactly. So moving on real quickly here. So you understand the concept. Sure, diversification is healthy. We're getting, find some places that you're really doing well, stick to them, but then add to it, right? Over time, it doesn't have to be a speed of light here. Go back
to the whole why are you doing it. I think a lot of times the reason why people are doing it is because they're hearing this from somebody else.
That's why I asked
and
the
I think back up a little bit farther than that, I think you always have to consider the source as well.
Sure.
So a lot of people that I know that are talking about don't put all your eggs in one basket, are talking about multiple markets, are also the people selling you properties in multiple markets and trying to pad their own pockets to a certain degree. And I mean, you always have to, whenever you hear anything, I don't care what it is, you should always consider the source and know what's the incentive for them to say that. And honestly, you should consider 100%. The story about us.
Yep.
I'm saying maybe you shouldn't go into all these markets, and part of the reason for that might be that I want you to stay with us.
Absolutely.
It's really not, though. I mean, honestly, like I've done the opposite. I've told everybody for the last 10 years, go and diversify, have these other markets. And then when I'm hearing my own investors come back to me saying, I wish I would have put my money with you, I'm now saying, I got to be honest with our audience and say, hey, like, do I think you should diversify? Yes, but maybe you shouldn't diversify as quickly and as broadly as fast as what most people would normally think. I would say move a lot slower at the beginning and work with people and develop that trust. Watch that basket really closely. And once that trust starts to develop, then you can start letting go of the reins a little bit, and it just turns on autopilot, and then it lets you develop other relationships. And that's the way you're really going to be successful. I believe that the right kind of success is the right person doing the right thing for the right reason with the right people. And I think that's what we're talking about at this point, really, is with the right people for the right amount of time. And, I think that it's just going to come with experience and long-term knowledge and that trust that you're going to develop with those different relationships.
Well, kind of getting back to that too. So because I'm sitting here thinking, of course, you have everyone saying everything and everybody could have a motive in your position. I think you're right to question it. However, it's important if you already have a good working relationship with somebody, you can trust what they say because you have a good working relationship with them. They've basically provided options for you and produced for you. So I do think it's very interesting. The next question I would say is when. So I think kind of going into what you said, you may have already touched on it, so you can breeze through it if you want, but you should diversify. We're not saying you shouldn't. Tom has said that clearly so far. But again, you're sitting in your seat. When is the issue? And it's not a matter of should I, it's when. And so sometimes it seems like people who are finding good opportunities are quick to leave them in the name of diversification. Mm-hmm. So how would you help someone with that as far as the when?
I mean, I believe if it's not obvious, it's not the right time. So, for me personally, I have been trying to start 2 other businesses. So in my own business here, I mean, we've got 7 businesses between me and Becky, my wife. Mm-hmm. And I have been wanting 2 other businesses, and now I actually have a 3rd one on my plate that but I'm telling you, what I've been doing for the last 2 or 3 years on one of these businesses is learning it, is tapping my feet into it and just kind of trying to see, am I good at it? Or am I going to be able to, make this happen? Is it successful? Is it something I enjoy? Is it something that is going to make me money? Is it going to be less risky? I think we have a great idea filter that if you guys want this from us, you guys can, get this from me and Jarod. It's an Olson Group idea filter that really, I believe you ought to ask yourself these 10 questions and compare them from different angles and really maybe different markets. So you might, go through the list and maybe, that idea filter, but I think you ought to have a filter for those decisions. And I think if it's not obvious, if it doesn't work and it doesn't fit, I think you should know pretty quickly. Right. So I would tell you always to start slow with anybody. Yep. And then once it works, okay, maybe you do one deal with somebody and then it works really well and you're like, oh my goodness, this is working really well. And a month later, 2 months later, okay, well now, if you really do want to deploy a lot of capital, I had a guy talk to me this last week and he's like, I have a lot of capital. I need to deploy a lot. And then, I mean, we're talking 8 figures. And I'm like, but I always push people back. I'm like, nope, you're not going to invest in me in that kind of, until we do a deal together. Yep, until, I believe success breeds success and builds success on top of building blocks. And, I honestly almost think that the worst thing that can possibly happen is for the deal to go perfect the first time. And I know that kind of goes contrary to what I just said about success breeds success, but I really do think that sometimes it's better to have a bad deal happen first, because then you can see how people react and how people work through it and how that adversity either gets somebody down or they fight through it and they still make it happen. So, but sometimes deals go perfect for investors for a long time. And I think that sometimes that gives us a false sense of security with a certain provider or a certain person, but things are gonna go wrong. It's like, it's not like if, it's when. They're, so they will go wrong. But as far as when they should actually diversify, I mean, I think there ought to be plans to do so way before you actually make the jump. So I would, if it was me, I would not be focused on more than one new investment or one new type of asset class or one new type of strategy at a time. I would start with one, learn the one, spend at least 3 to 6 months, and for some of us it might be longer, to really understand it, work with somebody, and then probably start learning about a new one before, for 3 to 6 months before you even do something, and then go into it. We do have time. I'm not trying to say that we shouldn't take action, because I think the action takers are the ones that actually always end up winning in the end, because they're the ones that were actually willing to get off their butt and do something. But we do want to make sure that we have prudence and exercise discipline and prudence with it.
So those couple questions were more mindset. Now we just have some general questions we're going to ask Tom, and we'll shut it down. So the first question is, how would you compare diversification with people who kind of get stuck with the shiny object syndrome?
Well, I think this is the reason why most people get stuck in diversification is because they have shiny object syndrome. I mean, I go to some of these masterminds and I hear all the time, it's like a kid in a candy store. There's all these different investments and I want to do one of each.
Sure.
And you don't really realize what that one thing that you're going to enjoy doing, or that one person that you're going to really enjoy working with, or that one asset class or that one type of investment that you kind of really gravitate towards. And so, I mean, I guess that's how I would think about it. Shiny object syndrome is the enemy of diversification. It really is harmful, and it can turn diversification into diversification very quickly because it helps. It actually almost talks us into doing more, different investments that we shouldn't do.
And it even goes into what you're buying. So for us, Thomas said over and over again that rentals are a long play. And when people have shiny object syndrome, they just can't stay in that deal too long. They just can't do it. They got to buy it. And then 2 years later, they're looking to move it because they need that capital to go to the next deal.
You got it.
And you haven't gotten.
It's sad,
really
honestly. Like the guys that I see that really do the best are the people that either stay with one person a long time and they may sell, but they're with that one person still. And then they're doing new things with them, or they're doing something else. But really, keep in mind, when you're buying rentals, if you're planning on selling these in the next 2 to 3 years, like, don't buy rentals. Yeah. Just lend, or just invest in a fund, or just do something else. But
you're not going to get that return.
Honestly, at the end of the day, like, the people that make the most money are the people that are really knowledgeable about a particular market, or a particular, or they have a really good relationship with that person, and maybe that person even puts them into some different avenues. Like, one of our investors loans money to us. He also owns rental properties with us, and I'm also managing vacation rentals for him. So in a way, he's diversified, but he has one trusted person and one party that he's dealing with several different things, in even the same market, but he's diversified to a certain degree in that same market.
And it, just kind of piggybacking on that, I even say that we do have here in Northwest Indiana the opportunity to offer you a diversified portfolio. We have D+ areas that have phenomenal numbers, and we can sell A product too. So you can actually even diversify within a portfolio in our market. That's just kind of a little commercial.
Absolutely, you can absolutely do that, and I think you should. I really do. I mean, right now, I think the time to buy that low class is right now.
Right.
But it's not around the whole country. Yeah. I really don't believe that. There's some areas of the country that are going to get killed. But I think that our areas, honestly, like, God protected us. I really believe that with we didn't have as many jobs lost, and the jobs that were lost, I believe, are going to come back. We may have a little bit of hiccup in the retail sector, but we don't have a lot of hospitality here. We don't have a lot of we don't have a lot of I think the three sectors that are going to get hurt the worst right now is, number one, hospitality. Number two is going to be retail. And retail, you have to understand, retail is already on a decline.
Sure.
Amazon has been taking over retail, and even Walmart. It's funny. Nobody has any idea the Walmart presence that they have online. Walmart is very big online. So Walmart has continued to go right through this. But all of your small retailers, like the malls, like, they were already going bankrupt, So retail is going to be second. And third, I really believe office space is going to be something that you better be really careful if you're in office space right now. Nationwide Insurance Group, I think they have 60,000 employees. They just told them they're all going to work at home permanently. And I think that a lot of other people are going to follow suit when it comes to that. So I think I think the strong markets right now, I actually think the next might be multifamily. I think there's going to be a little bit of a contraction in multifamily, but I still think it's a strong sector. I'm not going to tell you it's like something I would be running from, but I'm not sure I'd be running towards, myself personally. I still like storage. I really do like storage. It's kind of been one of these things that has been proven to be a little bit of recession proof, because guess what? During the coronavirus, nobody was taking their stuff out of storage, and they're on automatic payments. So I like storage, still like storage, although I don't think the return is super great. But it's solid and it's steady, and that's why I like it. And I actually think if anything out of this has happened, I really honestly believe single family has taken a bump up. We're seeing the demand go berserk in our rentals for applications, and people are telling us that they're coming from multi-unit complexes and they don't want to live there, if the government's going to shut down again. So there is a little bit of a thought process there to think through that. Now, I think some of your smaller buildings that have yards or have like things to do or may not get as hurt as bad as some of the big complexes that have hundreds and hundreds of units. But I know that their collection rates have also been lower across the country than a single family. At least all of my friends have been very proactive to get rents collected. And actually, our rents have been collected almost a higher rate than normal during this, so which has actually been a little bit surprising for us. But I really honestly believe that two market shifts are happening right now. One is multifamily to single family, and the other thing that's happening is that people are moving away from for the last 10 years, people have moved to big cities, and everybody's congregated and moved more from country closer to cities. And I actually think that migration's going to be the opposite over the next 10 years. I really do believe that we're going to start seeing more of a trend outwards, and those subdivisions and those bedroom communities outside of the big cities become more and more popular over the next 10 years, because I really do believe that this coronavirus has hit our psychology.
Sure, totally. It absolutely 100%. That's for sure. It's touched everybody in some form. And so, that is all we have for today's podcast. We hope you guys enjoyed this. This was definitely something that every investor asks at some point. When do I diversify? And we're trying to keep you away from diversifying. And so just remember that we do also build rental portfolios for investors. So here at Olson Group, we buy and sell constantly. So if you're looking to begin your journey as a real estate investor into turnkey rentals, we would love to have you. Give us a call. You can reach us. You can reach me directly at Jarod@buyolsongroup.com, or you can go to our website. And so, Tom, do you have anything you'd like to add?
That's it, Jarod. I think we covered a lot. I actually think we started getting into another podcast here, so maybe we need to talk about the coronavirus and what the effect it's actually had on everything. But appreciate Jarod doing this, and he does a great job working with our investors. And that's it, man.
Well, thank you for joining us. Hope you guys have a great time. And if you guys have any questions, we'd love the feedback. But Active Turnkey,
the best way to buy rentals.
See you guys. Olson Group Network makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Unless specifically stated otherwise, Olson Group Network does not endorse, approve, recommend, or certify any information, product, process, service, or organization presented or mentioned in this podcast, and information from this podcast should not be referenced in any way to imply such approval or endorsement. Any third-party materials or content of any third-party site referenced in this podcast do not necessarily reflect the opinions, standards, or policies of Olson Group Network. Olson Group Network assumes no responsibility or liability for the accuracy or completeness of the content contained in third-party materials or on third-party sites referenced in this podcast, or the compliance with the applicable laws of such materials and/or links referenced herein.